All right, good morning, everyone, and welcome to day 2 of the Global Fintech Fest 2022. I'm your host, Chaitanya Rathi. The world's largest fintech fest, this Global Fintech Fest is organized by the National Payments Corporation of India, Payments Council of India, and Fintech Convergence Council. This edition of the fest is supported by the Department of Economic Affairs, RBI, and IFSCA. All right, in case anybody has any issue with the headphone, you can reach out to any of our volunteers in the white shirts or just raise your hand. We'll help you sort that out. There's a volume button. There's also a long press that you need to do to switch on the headset and also to switch it off. And with that, let's get started with our first session for today, which is a panel discussion on the role of technology to finance the last mile. Our moderator for this panel discussion is Mr. Parthasarathi Patnaik, Chief Risk Officer at the Vayana network. And our panelists are Ramaswamy Iyer, Founder and CEO of Vayana network, Dhavan Shah of Country Head SME Banking, Yes Bank, and Kaushal Sampat, Founder of Rubix Data Sciences. Over to you, sir. Over to you.
Yeah, we'll just give him a minute to get started.
Let's do a sound check. Okay.
Great. Good morning, everybody, and thank you for coming in early for the session. Great to have this panel with us. Very august panel, having a very diverse experience. Right before me here is Kaushal, who's actually part of the data analytics world. We've got a banker in the form of Dhavan, and we've got a serial entrepreneur, Ram, out there. And today's session, I think, is around financing the last mile. And I think three of them really bring in very diverse experience to help us understand and run through this. So I thought we'd just start by first trying to define what we mean by the last mile. And if we could just take turns at really getting to understand what we are trying to discuss here and find solutions for it. So Kaushal, if you may try and help us understand what is it that we're trying to solve for at this point in time.
Sure. So I think the key thing to, when you talk about last mile, there's obviously two ways to look at it. One is from a geography perspective, as India moves to Bharat and Tier 2 has done, Tier 3 is done. But as you look at smaller towns, cities, villages, where credit is really being consumed now and is more than consumed, is really required there. So that is one definition that I would say last mile. What are we doing in order to make credit available in those locations? The second, I would say, is the type of businesses. When I say, when you talk about lending, you talk about credit, the first thing that comes to mind is formal credit going to corporates, mid-sized corporates, even SMEs. But I think the real growth is the proprietorships, partnerships that make up Bharat. There are 20 million credit active businesses in India, trade credit active businesses in India. Are we actually supporting them in achieving their potential by making finance available to them when they require it and as they require it? So I think last mile to me is both those things. If we want to succeed, we have to get both those things sorted.
Right. So you're talking both about geography and you're talking about size of this counterpart.
Absolutely.
Right.
Absolutely.
So, Iyer, Ram, if you were to define, what kind of characteristics this particular community really has, what would those be?
I think multiple things. I think obviously they are all small businesses, and I think what I often call them is, are they ready for credit kind of businesses? Because I think one is to say that you want to provide credit to them. Are they also ready to accept formal credit? Because a lot of them have mechanisms of getting credit or not getting credit. The question really is that do they have the ability to take credit? I think that means last mile, where a lot of education is required in addition to, I think, banks and other regulated institutions reaching out for credit or platforms like ours. So I think that's the first aspect of it. The second, I think, is the entire credit modeling itself. I think, how do we arrive at it? Because I think, we have been talking about cash flow lending models, and we'll talk about that later. I think at a really small micro nano enterprise, less than 1 crore of revenue, you really have to think about what kind of models will work there. For you to kind of give credit, collect credit, and I'm sure Dhavan will talk about a lot about all the aspects of credit that one needs to take care of. So I think, really speaking, to me, the last mile is really a frontier where you have to also figure out the receptivity of for credit, formal credit, in that space.
Got it. So clearly there is, underlying this entire discussion, the fact that there is a problem in getting credit to this particular segment. So Dhavan, in your opinion, what is it that's really holding back the banking system from getting to this segment, which needs a solution?
Okay, so I'll further cover it in two aspects. One is how sort of we are born and brought up, right? So the cultural aspect of how the lender works, right? Secondly, why do we lend, right? So I'll cover the second part first. That essentially it's a demand and supply. To start with, in any of the business model that you get into as a lender. If I look at the space, is there a demand? I think there is a tremendous demand. So I don't think there is an issue of not having enough size or scale available for us to go out in the business. I think that issue does not exist. On the supply side, you have the components of your ability to distribute or originate a transaction or a loan, your ability to underwrite, with what you are comfortable with, your ability eventually to recover or collect the money back, right? And if economics works out fine, that's where you make money. So effectively for us, from a commercial viability, the first essence is the cost of origination, cost of managing the credit underwriting, and the cost of collection. And finally, obviously, is the credit cost, right? Finally, the losses that you have. And as long as you get the interplay right, and if you're able to minimize the cost of doing business, it also actually gives you a larger appetite to absorb the credit losses, right? Because you are still being able to be profitable then. So I would say it may not be a mindset issue, but it's just that we have seen a set model which has worked very well for us, right? And traditionally, it's still a brick and mortar. However, we talk about digital, the actual digital lending in India, whether in the household or the MSME, in fact, MSME side, it's virtually zero. It's still touch and feel. I want to see the customer. I want to see whether he's doing business or not. It's a relationship-driven businesses that we do, right? So I think large part of play is still about getting a sense of what the market is, segment is. Am I able to see the business myself? Can I see the factory? Can I see the collateral? The second underlying it is obviously the availability of collateral. If you don't have a property, I think that's the first deterrent, because the segment you are talking about is sub 15 lakh, 20 lakh ticket size at best, right? So anywhere between 2 to 15, 20 lakh is the lending ticket size that we are talking about in the micro or the nano enterprises. Third is how we underwrite, which is still basis the third party or the audited data, right? So your need for GST, you need for audited balance sheet, you need for income tax returns, and a whole lot of bank statement and multiple things that you ask for. So there is a comfort zone, if I have to use that word, but the fact that you are used to doing with it and it's working fine so far, maybe you're not pushing yourself to then solve the problem for somebody else, because it's just working fine. But if somebody were to think differently, that while the market is there, you are doing business, it's getting competitive, but there is a completely new space out there which nobody has touched, I think there is a tremendous potential to up the game from there. So I think that's how I look at how the bankers think right now and what can change.
Okay.
Yeah, now we got it back.
Yeah, no, we lost you for a bit. It's fine. Yeah, so thanks. So Dhavan, so I think just to paraphrase a lot of what you said, one is, of course, very clearly there is a commercial consideration that banks have, which probably doesn't make sense in the last mile, and we need to solve for that. You also mentioned about mindset, where there is this need for collateral, etc., which again is years and years of banking has led to this. And then there is the part around understanding the credit, underwriting process, which probably needs to get changed. So if we were to just go down each of these, wormholes, if I may, and figure out what is it that we can do to solve for this from a technology perspective, that'll be a great place to start. So,
Sure.
Kaushal.
So I think what I'll focus on is probably the third one, which is the method of underwriting.
Right.
You're absolutely right. We've all been brought up in the tradition of cash flow based underwriting, using traditional data sources, structured data sources as we call them. So income tax returns, now GST returns, so on and so forth. But the world is rich with data. Structured and unstructured data and unstructured data, particularly for smaller businesses, is the key to understanding them and doing business. A lot of these businesses, micro, nano, that Ram talked about, are sub 20 lakhs, so you may not even have a GST. They may be outside the ambit of GST. So how do you lend to them? You have other, I would say, very valuable data points. Can we get their utility bills? Can we, look at other unstructured data sources that exist for them? Can you look at benchmark-based lending? That's something that we do at Rubix, which is where we look at essentially what is the size of a small business. What is the a benchmark PNL of that business in that locality? You'll have some where you can get a size and estimate, and then you apply that to others. So there is a physical size, there is utility bills, there is social media, and this we ignore at our own peril. There is so much about these small businesses that is out there. Are we actually able to get that in? There's also litigation data, and you'll be surprised, especially for small businesses. Sometimes you get your Section 138, check bounce cases, etc. All this is available on e-courts. Integrating this quickly, being able to bring that into this will allow you to get an idea of size, idea of the business that they do, and then go out and lend it. So I think it's as much a need for building innovative, credit scoring models using these data sources, unstructured data sources. Today, we have over 120 unstructured data sources that we use. And that data is available pretty much free of cost. It is available regularly. For all lenders, whether trade credit, whether bank credit, whether any credit, you have that available. And the last thing I'd like to say is that a lot of these guys work with, say, FMCG companies, etc. These anchors, are they able to give you their accounts receivable on the basis of which you're able to generate payment scores, which again fit into the credit model? Are they paying on time? Are they, how are they paying, etc.? What's their payment history? Are there defaults? If you can build, and lenders have the ability to do that, if you can build a model around these anchors, sharing data and build scores around that, I think it makes it very, very rich data, which allows you to lend effectively or score them effectively, which in turn gives you risk-based pricing models. To Dhavan's point about being able to, sort of manage for, profitability, you're able to build risk-based pricing models. And do it accordingly. So think about the credit bureaus some time ago, right, and think about now. I mean, it's changed, right? So I think the same thing is possible in this space.
Yeah, I think completely agree with you. The big change right now is also the fact that a lot of this information is available in the public domain. So there is so much more ability to go out there and crunch this data and make sense of it. But if you were to, solve for the first problem that Dhavan talked about, and Ram, if I can throw this at you, there is a commercial consideration that banks have, which actually holds them back from doing much of what we just said. How do we actually solve for that using technology?
So I think let's first start defining the problem, right? At the lowest end, there's the micro and nano, their net margins are typically 2 to 5%, which means that they can't afford actually expensive credit, which actually makes the job of bankers to kind of figure out how to kind of price it even more difficult, because when you start pricing it at 1.5% a month or 1.2% a month, that's often a very large portion of the net interest margin, net income margins that these guys have. The second point, I think, really speaking, is that if you really want to reduce the cost, you'll have to figure out how to use the supply chain. I'm biased towards supply chains because that's all I do. But I think the real important thing that Dhavan talked about, that India is still a physical market. Okay, you can get data to underwrite, but you can't get data to collect. You still have to go and collect. You still have to have a mechanism of monitoring. I think what we have done in India is have a lot of physical supply chains where people are going and meeting their respective small businesses, micro businesses. Kaushal talked about FMCG companies. I think we have built a huge systems over a period of time of people regularly going and meeting them. That's the force that you'll have to look at from managing the physical distribution of credit, which includes the actual portion of giving credit, collecting documents, of collecting credit, and you'll have to figure out how to use that mechanism. So I think the real important thing really is to figure out from a bank or a lender's perspective is to really see that can I use the existing infrastructure on the ground, marry it of course to what Kaushal talked about, all the data, and then figure out whether I can still make that cost of credit at a point where the small micro nano business thinks that it's a priority to repay this because it's the cheapest form of credit. I think that's really the key problem statement for all of us.
Got it. No, and I think the other part about this segment is the fact that it is very large in terms of the number of counterparties, and they are very, very geographically dispersed. So, in part, one of the big problems here, as I understand it, is how do we scale a business of this kind? Yes, we can, provide a product for each of these customers, but from a lender's perspective, and this is to you, Dhavan, how does one actually build scale in this business?
Right. So I think let me add to what both Ram and Kaushal said and sort of try to visualize the model. But let's go back to how the household credit has evolved in terms of people going door to door and trying to ask the customer whether you need a car loan, you need a home loan, you need a credit card, right? Now, obviously, there was a lot of misfire because you were not sure whether the customer needs it at that point in time or not, right? And the model then evolved to where does customer go, where I be able to talk to 100 customer rather than one customer, and the need is verified there, right? That's why your car dealer model, where the dealer is originating a car loan, is the model which came, right? Because if essentially I'm visiting a dealership, it's is the need for buying a car there. And if I'm buying a car there, probability of needing a credit is very high, right? You go to a builder, you are looking for a flat. Obviously, somebody comes next, they say, "Are you looking for a home loan?" Right? Or you go to super malls, your electronic stores, and all. That's why the guys are standing and saying, "Do you need a credit card?" Because you are making a high value purchase there. So I think essentially the scale will come where you need an intermediate entity which is going to aggregate these people. And I'll say both from a physical and the technology perspective. Now you look at most of the segment we are talking about are essentially the retailers, right, in the service or the goods space. And I know of a lot of FMCG companies who have tried to reach the last mile in terms of data of their inventory management, their ordering system, their CRM system, which means while the dealer distributors networks are still there, a lot of companies are now able to talk to the retailer as an end mile, and he actually knows the velocity of sales, which goods are picking faster, which are slow moving consumer goods. So if you are able to actually access that network, then your ability to reach out as a scale, I think, is not a problem, right? So if I have to look at an equivalent, is the delivery distributor today for SME in the FMCG space, is it as good as a car dealer for me to access those network of people, right? The only challenge or differentiation here will be each of the retailer will be talking to multiple dealers of multiple companies, right? It's not one-on-one relationship. And I think that's where the platform aggregators comes into play. So if you have to really build a network map of top 100, let's say retail distribution companies on manufacturing space, their aggregate distributors, dealers, and the retailers. If you look at it, it's a mammoth task to start with, but I think it's very easy to achieve eventually where you exactly know who is talking to whom in terms of payment and the goods movement which is happening. And if you're able to access that network and aggregate data, I think the problem can be solved, right? But it does require effort on somebody's side to be able to get the anchor and the dealer and the distributor together on the platform. And then you start building the retailer network on that aggregator platform. The richness of the data, I would say as a banker, if we were to change something, it's moving from a cash flow based financing to then look at where the goods are moving or the products are moving, right? So instead of saying where the cash is moving and hence what is the working capital cycle, if I know where your goods are moving every day, which are fast moving, which are slow moving, what's the velocity, what's the kind of working capital you need basis the goods which are moving, I think it solves the problem of data, right? Lot of surrogate data that he spoke about is, are you paying your electricity bill on time? Are you paying your mobile bill on time? Because that's the last thing you want, your mobile phone getting cut, your electricity getting cut. But it actually gives you a sense of the discipline of a person, right? If he's paying it timely, however small that amount may be, whether it's 250 or 500 rupees, it gives you some sense of comfort to a banker or a lender that yes, the guy has a discipline of paying things on time. And you add the data of the product or the goods movement, I think there is a potential scale to be built on the credit scoring point of view, which means it cut down the cost of paper-based or document-based credit algorithm that you run. And you need a strong AI tool also for decisioning, because today while we extract data, to that extent digitization helped you get a GST data, ITR data, but you still interpret manually, right? You accumulate everything. So it's just that your preparation of sort of CAM or the paperwork has become easier, but you've still fallen in love with reading those 20 pages and taking a decision, right? For a 5 lakh ticket, you can't afford to do that, right? So if you mix two in terms of the network available, aggregators coming into bringing them into common platform, and you use strong AI tools to actually decision, I think the problem can be solved from a scale perspective for sure.
Yeah, makes a lot of sense. But on the point of data, and Kaushal, this to you, it's easier to get data ab initio as you're starting out the process of assessment because that is the time at which the borrower is most, likely to give data. But subsequently, as you need to monitor that particular counterparty or this large pool of counterparties, how do you actually solve for the problem of getting data on a continuous basis to actually make sense and take care of your portfolio?
So I think it's Dhavan made a very interesting point, right? Ab initio, of course, you're going to get the data because people want credit. The idea is that if you you shift the paradigm a little bit, shift the model. Don't look at the borrower or the SME or the micro or the nano as being the source of the data. Because if you look at it, that itself is a bit of a hurdle for them, because for them to put together documents, etc., to give it to you on a continuous basis is a problem. You look at how you can source this data in a digital way, in an automated way, using unstructured or utility bills, etc. You're able to get it yourself. It becomes easier. To the point about the anchors, why do anchors sometimes hesitate to share data? Because they think it's going to leak. All CFOs of companies, all legal heads will say, "Nahi, mera data kahin jayega. I am not going to share with you because tomorrow someone else will have it." What does for example, a credit bureau do in the banking system, right? It anonymizes the data. So no one is worried about data going to anyone else. Can a platform actually do that? Can you anonymize that this is not a Unilever customer, this is not a Dabur customer? We've built out at Rubix, we've built out a private credit bureau for the gems and jewelry industry. The top 11 gems and jewelry manufacturers in the country who are supplying to all the retailers. They all share data with us. And on the basis of that, the risk is scored, the risk is monitored on a monthly basis, and where there is a delay or a default, is X being paid on time, Y, without knowing who X or Y is, you're able to anonymize it and get that information. I think platforms can do that. I think banks can ask anchors to help them set something like that up, and it is fairly easy to do. I mean, it's a technology intervention, and then automated scoring to the point. We don't touch. There is no analyst looking at the data. Once the models are set, you have a probability of default model set up. It's just monitoring it, and you just make sure that if there's a check bounce or anything, you're able to get that regularly. So it's digital, it's analytics based, and it is aggregated at a different level. And you're not bothering that poor guy who's got to run his store, and he doesn't want to sign 400 pages and give you 400 pages of information every month.
Yeah, I think the key is to get this information without really,
Exactly.
getting in the way of his business.
Exactly.
So, on that point again, and Ram, this is to you. So we're talking about these 20 million counterparties who need financing. We kind of solve for how do we access this pool, how do we assess them. But what about actually running this large, portfolio of borrowers? The number of transactions, the volume of activity is something else altogether. So how does one solve for that really? Because banks are not really capable of doing that at this stage.
Well, actually, despite being a platform, I have to disagree. I think banks are quite capable. And I'll say yes to Dhavan also on that. But I think the key question really is that ultimately, I think taking Kaushal's point and your point also that we summarized it, technology cannot come in the way of that business to operate. A nano or a micro business is basically doing job of 20 people at one time. You cannot ask him to, and one of the big issues that I have at least is that we have introduced a lot of these apps and URLs and everything else, and everybody looks very good, but it's all digital friction for that guy. It is not digital friction for someone who has an accountant or a CFO. So when you take the small guy, if you want to introduce that technology and the platforms, you have to embed it in such a way that he does not have to do 20 more things to kind of get it done on a daily basis. So you have to be very, very smart, I think, about using technology in a way it's invisible. And I think, at Vayana, that's been our, secret sauce, is to not actually be visible to the customer in some sense, to ensure that he's not really thinking about financing. Honestly speaking, nobody likes financing. I mean, everybody wants to get on with their business, buy, sell, and get money. So I think the trick really, if you want to scale this platform up, if you want to say 20 million businesses can run on this day in, day out, I think the technology that you have to build is not really a technology along the conventional lines, saying that I have now built a much more better user experience, convenience kind of an app. It's to say, how do I embed it into his trade so he doesn't even have to kind of think about it. But for that, I think the first thing in India, at least especially in India, you have to make sure that the commercials work out. And I think that's really the key, because today we have a lot of convenience coming up in the market, but the rates are very, very high. You have to think about, and I think our job has been very simple, how do you get it to below 1% a month in terms of interest cost for those guys, especially the micro and nano, which we have to really marry all of the stuff, the risk part, the collections part, the default part, the information part that Kaushal talked about. And then I think the key question then after that is that you bring the technology in that somebody is really not kind of thinking about it. I think that's the key to kind of making it available to 20 million micro and nano enterprises.
No, I think well said. Technology is not necessarily the cure. I mean, there's a lot more to it than meets the eye. Is there also scope for innovation in the product construct that we can offer this particular segment for them to actually come into and really borrow from the banking system in larger numbers? We talked a bit about, Dhavan, you spoke about collateralized lending. There are gold loans on the one side, and then there's supply chain finance. Is there a way to marry some of these different products, make it available to this ecosystem?
So my sense is, Partha, anything which you add in the name of collateral, whether gold or property, from a ticket size perspective, the cost of physically handling any of this is going to be a deterrent always, right? So this has to be unsecured, or at best, depending on how the regulators move on this space or the government moves. I think there are schemes of Mudra and some of the credit guarantees available, right? While there is a scope for improvement and can be embedded into it. But that's really the segment for which these schemes are actually meant. So first is very clear, it has to be similar, it has to be data driven, right? So as much is the less friction or less human intervention, I think there is a potential to do this business in a profitable way, for sure. I would say a lot more product innovation, but possibly more from the perspective, how do I collect the data, which are my touch points, what am I changing from my current metrics, how am I assessing it, right? And then how am I actually doing the actual collection of collecting my interest or the EMI, right? Is there an escrow mechanism which can work between the retailers and the dealers, right? So every money which comes in, I take my share, rest goes to dealer. Is there a better way to do it? Every digital payment which is hitting the customer, whether it's through UPI, QR, or the POS or the card businesses, either 1% of that, can I keep it aside? It's just like the way we work on piggy bank, right? So every day you have something, put the chiller back there. But that's the collection mechanism which works on actually getting the money back. So if you're able to solve that problem of delivery and the transactions and keep as less human intervention as possible, there is definitely a commercial viability possible into this business.
Great. So I think we're just almost running out of time. Maybe I'll just summarize. I think clearly this is a problem which is solvable. It's a very large problem. The problem also is in good hands. I think there are a number of fintechs out here, the banking system at large, as I see it, who's actually working towards solving this problem. And clearly there are ways, the problems are really at the top in terms of sourcing, in terms of actually providing technology, in terms of analytics and so on and so forth, all of which need some solution or the other, which needs to come together in a form that the small borrower actually feels enticed to come in and borrow at a low rate from the banking system. So with that, I'll just offer a round of thanks to this very esteemed panel of ours. And I hope you've had a good session and enjoyed this particular interaction with the team. Thanks.
Thanks,
Thank
Partha.
you. Thank you, Partha. Thank you.